Hello, everyone. It is Jay Sanford, Director of Investment Strategy at Washington Financial Group. Thought I would check in, give you some new numbers that we've been working on over the past couple weeks. As you know, we have a market update at the beginning of the year, and we generally update that mid-year, June, July. But as I expected, given what's going on in the world, that we would do our best to update those numbers sooner than June or July. Obviously, we're in an unprecedented time, and some guesses are just as good as others, quite frankly, because we don't really know how the economy is going to react when it's reopened, what reopened actually looks like. But we wanted to get some ideas and numbers out to you based on what we see. We have a base case type scenario that is revised from our previous forecast. And we have a bear case as well, which would be on the worst end of things if that were to happen. It is the Monday after Easter. So some of these numbers, we run these and we have to shoot things through compliance. And so a lot of these numbers were based on the beginning of April, and we're already almost 2 weeks in. And obviously things have changed dramatically in those 2 weeks. We had our best week of returns in quite some time, since the 70s last week. So we'll do our best to keep these numbers relevant, but just be aware that obviously things are changing on a daily, if not hourly basis when it comes to the market and how things are looking. It is, hope everyone had a good Easter. I know my Greek friends still have Easter to come, so I know they're still looking forward to that, but it was a good, generally decent weather weekend in Washington, D.C., so although we are on lockdown, our ability to get out and exercise was met with pretty good weather, so that was good. Silver linings when you're looking at all of these things. So if you remember, we had market forecasts at the beginning of the year before all of this started. We thought the S&P earnings per share would be around $175. The S&P fair value we thought was between $3,200 and $3,300. And we saw the 10-year Treasury between 2 and maybe 2.25. So those were our January forecast. That was based off of what happened in 2019, what we saw going forward, and obviously everything hit the fan starting right around that time, quite frankly, in China, and made its way over here to the U.S. So our new numbers, base case, we think the 10-year Treasury lands around 1.25 to 1.75, which would obviously be quite a jump from where it is now, which means bonds could experience quite a bit of volatility in the few quarters ahead. Our bear case scenario obviously puts the Treasury between 0 and 0.5, which it has danced around a little bit over the last couple weeks. The earnings per share for our new base case lands at 158 to 162. Our bear case scenario, 138 to 142. So you can see that the uncertainty is out there just based on our base case and bear case scenarios. Fair value on our new base case is 3150 to 3200 on the S&P. And bear case retests the lows at 2200 or lower. And so, again, I realize we're giving ourselves quite a bit of leeway, but there's so much uncertainty out there that we have to give a few different scenarios and be prepared for whichever scenario comes through. Global GDP we thought was going to be at 3.5%. We do see base case-wise, if things kind of trend the way they are, we still could see positive GDP by the end of the year at 2.5% to 2.75%, and bear case obviously puts it anywhere 1.5 to 2, depending on how things react and how the global economy starts to open. We obviously see things in China already starting to open, and hopefully we can take a few lessons from them and apply them here in the United States when it comes to the economy. In general, we're favoring large caps over small caps right now, simply because we are going into or are in a recession right now. Large caps generally tend to do better over small caps based on the financial conditions. They have better balance sheets, greater earnings stability, that sort of thing. Now, remember that if we are in a recession, that what comes out of recession usually leads our small caps and high yield bonds. So portfolio-wise, large caps make sense right now. If you are looking to risk up and look a little bit further down, small caps might be the play long term, obviously. Large cap growth versus large cap value, we're going to stay relatively neutral on that. We do like the United States over the developed international at this point. Europe still has physical deficits to deal with. Populism may continue to weigh in on sentiment. Spending has always been an issue there. So, and obviously Italy and Spain, some of the hardest hit countries are having a harder time coming out of it. So we like the U.S. over developed international. We do like emerging markets. So China has led the way out of the global crisis as of now and supported emerging market equities in general. They remain attractively valued relative to the developed market counterparts and should return to pre-crisis economic growth rates before Europe, Japan, and maybe even the United States. If you're looking deeper into the United States, what looks attractive, what doesn't, generally speaking, industrials, communication services, technology, financials, healthcare, those would be the sectors that we think have some promise or have maybe some clearness to them going forward. Energy, still a big question mark with the way oil has been. Consumer discretionary, very difficult to understand only because we don't know how the U.S. consumer is going to react when things, quote unquote, get back to normal. Utilities, still a big question mark based on their dividends and their sensitivity to interest rates. Consumer staples and real estate, still pretty unclear as to how they're going to come out of this. So that's the update. Fixed income wise, we want intermediate credit quality corporates. It's really tough to say that to be in U.S. Treasuries right now, given where the 10-year Treasury rates are. If we continue to have shocks to the system based on this crisis, obviously U.S. Treasuries is the place to be. But long term, we think interest rates will eventually rise, obviously. And that could hurt interest rate sensitive bonds, Treasuries being the biggest culprit of that. So that's where we stand. I know we've given ourselves quite a bit of leeway when it comes to the ranges that we're using. There's a lot of uncertainty out there. We know that markets hate uncertainty, so we're hopeful that good news abounds going forward. Might be tough. We appreciate all of our clients and the communications that we've had with them. We've had some great communication. We've had some great conversations, both when it comes to their portfolios and just life in general, and we certainly do appreciate that. So be on the lookout for more calls from us. As I've always said, please don't hesitate to give us a call. We are here. Communication is of the utmost importance in these types of times. And so we truly look forward to talking to you now and in the near future. If you have any questions, feel free to reach out via email, via phone call. Happy to discuss things on a more personal or granular level if you want to do that. Hope everyone is doing as well as they possibly can. Stay home, stay healthy, exercise, try and eat right, maintain your schedules, and we'll get through this together. We'll talk to you soon.
That's going to do it for this week's show. Thanks for listening. If you have a question that you'd like us to address in a future episode, shoot us an email at info@washfinancial.com. If you enjoy our show, we'd love for you to subscribe on iTunes or wherever you access your podcasts. The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Global Retirement Partners, LLC, a registered investment advisor. Global Retirement Partners, Washington Financial Group, a division of Hub International Mid-Atlantic, and Hub International are not affiliated with LPL Financial.
Hey everyone, it is Jay Sanford, Investment Director. God, here we go again. I'm not sure how that works, but hey, to each his own. And I do not want to even say that.